Hey, how's it going, guys? Welcome to the Module 5 of Technical Analysis Foundation, the complete professional trading course for beginners. After going through the first 4 modules, we finally come to the Module 5, which is all about building your own trading system. If we think of this entire trading course as like a driving class, then the first 4 modules are the theory classes, and this Module 5 is the one that will take you out of the classroom and let you drive on the real road. I will share everything you need to know about building your trading system so that you can trade in a correct way with your real money. There are 2 sub-modules in this Module 5. In the first sub-module, you will learn what are the key components that you must have for designing your complete trading system. In the second sub-module, we will go through a real-life trading system example. It's probably one of the most famous trading examples. It's called the total trading system. In this video, we'll go through the first sub-module, Module 5.1, the components of a complete trading system. We've come a long way to this point. Let's do a quick recap on what we have learned so far from the first 4 modules. In Module 1, we learned the 3 pillars of successful trading, and you must trade with an edge like casino owners. In Module 2, we learned how to read the chart, which is one of the most fundamental skills that every technical trader should have. In Module 3, we learned how to analyze market structures and how to trade with different patterns. Then in Module 4, we went through the importance of risk management in trading. So the question is, can you be a trader now with all this knowledge and start earning consistent profits from the real market? In other words, are this theoretical knowledge enough to make a consistent, profitable trader? Apparently, the answer is no. Pure theological knowledge will not make you a consistent, profitable trader. As I mentioned earlier, if trading is like driving, then no matter how many books you read about cars or how many videos you watch about driving, you are not going to be a good driver if you never experience how it feels like on the real road on your driving seat. Don't get me wrong, theoretical trading knowledge are still important. They are the fundamental cornerstones of trading success. But we all know this world is full of people knowing everything about trading, but just can't make consistent money. So after we equip all this theoretical knowledge, and what truly makes a trader successful and making consistent profit, I'm going to share with you in this tutorial. And the secret hides in a combination of 2 important parts. First, you need to have a complete trading system with an edge. Trading is a business. Every business has a business model and a business plan that generates the profits. Your trading system works exactly like that business model. Second, you need to have a solid trading psychology to execute your trading system. Plan plus execution. That's what makes a consistent, profitable trader. So now, let's focus on the first part and take a look at how exactly you can build your own trading system with an edge. First, you want to make your trading system mechanical. Most successful traders around the world, even including those algorithm traders, use mechanical trading system. A good mechanical trading system automates the entire process of trading. It provides answers for each decision a trader must make at any moment during the trading. It makes it easier for a trader to trade consistently because there is a set of rules which specifically define exactly what should be done. It sets your trading priorities right, helps traders to focus on what you can control and embrace what you cannot control. Also, a mechanical trading system can isolate a trader's emotional judgments and subjective biases during the trading. So how does it feel like to trade with a good mechanical trading system? A good mechanical trading system should make your trading process simple and boring at the same time. Simple but easy to follow. Boring but consistent. That's how it feels like to trade with a mechanical trading system. So there are 6 key components of a complete trading system that works hand in hand to produce results. No traders can compromise any one of these key components. So what are these 6 key components? They are market, position sizing, entries, stops, exits, and rules. Every single profitable trader in this world has to define these 6 components in their trading system. Now, let's go through these 6 components one by one and learn how exactly each component works. First, market. This component defines what to buy or sell. The first decision in designing a trading system is to decide what markets to focus on. Different traders might have different ways to categorize markets. For example, you can categorize markets by asset classes, like I will focus on currency market or stock market or commodity market. Or you can categorize market based on the structures, like I will only focus on the markets that are trending. Or even if you only trade stocks, you can also categorize markets by different sectors and regions. For example, your system might only focus on the US technology stocks. No matter which way you categorize the markets, your system must have a clear defined focus on what markets to buy or sell. You need to find the right balance between trading too few markets and too many markets. If you trade too few markets, you reduce the chances of catching good trades. However, if you trade too many markets at the same time, it will take a lot of more efforts to manage. And the chances you make mistakes will be much higher, especially for beginner traders. You want to trade the markets that are moving. Please avoid trading those markets with little volume that doesn't move. Here are some new tips for new traders. First, start from the markets which you are most interested in or most familiar with. Second, if you're a beginner trader, you can try to trade trendy markets over ranging markets. Alright, the second component is position sizing. It defines how much to buy or sell. Position sizing is the most crucial part in designing a trading system, but it's also the part that most of the new traders ignore. You don't want to be one of them. You have to take position sizing seriously. How much to trade affects both of your risk management and diversification. Risk management controls the maximum risk you are taking per trade, so that you are not betting too much or too small. Diversification controls the positions from different markets or different directions, so that no matter if the market goes up or goes down, you always have the opportunity to make money. We have gone through a lot about the position size in the previous module, and here are some of the tips, especially for the new traders on the position sizing. Tips number 1, for the new traders, never risk more than 1% of your capital on one single trade. Tips number 2, for the beginner traders, always avoid trading too many instruments at the same time. For example, as a beginner trader, if you want to use option as your main trading instrument, then focus on how to trade option first. You should not jump around to other instruments that CFDs, futures, or swaps, because different financial instruments will have different risk exposure, even to the same underlying markets or assets. So your position sizing strategy will be messed up if you trade too many different financial instruments, especially those really complex instruments. So focusing on one single instrument is good enough for your first 2 years of trading. The third component is entries. Entries define when to buy or sell. It's kind of opposite to position sizing. The entries is probably the least important component in any trading system. It's not really that important, but it's the part the traders are most obsessed with. Some traders prefer using pure price action to define entries, and some prefer using complex indicators. There's no right or wrong way, but your strategy needs to have an edge when you define the entry point. Clarity is the most important thing when you define your entry point. Your entries must be clear. It could be an exact price or a narrow range of the price. Also, the underlying reason for your entries must be clear too, which means you need to have a very clear understanding why you should enter your trade at that point. That's what we always say in the trading. Clarity is the first step to conviction. Tips for new traders. Number 1, for new traders, focus on one strategy first and fully understand what makes this strategy work. Tips number 2, for new traders, trade reviews is very necessary to do them regularly. Review your entry strategy based on a decent amount of trades. Do not judge your entry strategy based on just 5 or 10 trades. That's not enough. I would say 50 to 70 trades over 3-month period of time would be a decent number to do the trade review to see if your entry strategy works or not. Next, stops or the stop loss. It defines when to get out of a losing trade. We use stop loss in our system to manage our risk. We all know that traders who don't cut their losses will not be successful in the long term. The most important thing about cutting your losses is to predefine your stop loss point before you enter the trade, not after. Simplicity is the key. Your trading system has to clearly show where you set your stop loss, and it cannot be complicated. The reason why we need simplicity during the process of setting your stop loss is because it helps to isolate your emotion away from your trade decision making. For example, your fear and hope. So here's some new tips for the beginner traders on setting stop loss. You can try to use average true range to define the range of your stop loss. Your stops should be somewhere between 1.5 ATR to 2.5 ATR. So that will be the range for you to set your stop loss from the entry price. Alright, the next key component is the exit. If stop loss helps us define when to get out of a losing trade, then the exit helps us to define when we can get out of a winning trade. In trading, you probably have heard let your profits run, but what they didn't tell you is that you need to have a strategy in your system to let your profits strategically run. Because if you don't, you might take profits too early, or even worse, your winning trades might eventually run back and become a losing trade. Predefining an asymmetric risk-reward ratio is important in designing your exit strategy. You need to make sure that you are taking smaller risk to gain bigger profits. Once you trade for a while, you will understand that actually taking profits is more difficult than cutting losses. Taking profits too early or too late can both hurt your account in the long run. So here are the tips for the new traders. 1 to 3 risk to reward ratio can be a good starting point for new traders to develop your own exit strategy, which means, for example, if you risk $100 on each trade, then your profit target should be minimum $300 on that trade. The last key component is called the rules. We use rules to define how we buy or sell and all those what-ifs in our trading. What does it mean? If the first 5 components give you the manual of the driving your trading vehicles, then this last component will be the set of traffic rules to help you stay in your lane while you're driving. There are many reasons we need a set of rules in our trading system because primarily traders use rules to deal with 2 things, freedom and uncertainty. The ultimate blessing that everyone is striving for, the freedom, can be the biggest curse to many traders. You cannot do whatever you want in the market. Having a set of trading rules is your only way to stay away from being crushed by the madness of the Mr. Market. Next, the only one thing that is a 100% guarantee in the game of chances is uncertainty. No one can avoid it. In fact, you should accept it and embrace it. That's why we need to give our system a set of rules to expect and react to those what-if situations before they actually happen. Rules are developed over time and experience, and most importantly, from your own mistakes. So tip for the new traders, write down your trading rules on a piece of paper, read it out loud every morning before the market opens, and then refine it regularly by learning from your own mistakes. Alright, there you have it, the 6 key components of a complete trading system. These are the 6 things you need to make sure you have before you start trading with your real money. There's one interesting rule mentioned in the book, Market Wizard, called the 90-90-90 rule. I would like to share with you guys right now. It goes, 90% of the new traders lose 90% of the capital in 90 days. Why does this happen? Very simple. Because the new traders do not have a trading system to plan their trades. The confidence, the consistency, and the discipline that develop from a well-designed trading system are the keys to many of the successful traders. That's why we always say, if you fail to plan, then plan to fail. There are many intangible values of having a trading system, especially for beginner traders. The very first intangible value is that having a trading system can force traders to think of trading as a business. Every business will need a business plan. Your trading system will work exactly like your business plan because it tells you exactly what your business model is. Your profits from your winning trades are the revenues, and your losses from your losing trades are the cost of doing this business. This is a very crucial mental shift that every new trader should make. Thinking of trading as a business is the key towards becoming a consistent profitable trader. A well-designed trading system can help traders become more disciplined, consistent, and confident. If you only rely on your own judgment instead of a trading system, you will find that you become fearful when you should be aggressive, and you become reckless when you should be cautious. Also, another important intangible value of having your own trading system is that it stops you from trading on other people's tips or signals. Signal services and online tips are really dangerous things for beginners learning how to trade. And last, having a trading system will allow you to review your trading results and where you can improve to achieve a better result and become a better trader. So these are some of the intangible values of developing your own trading system before placing your first trade. Legendary trader, the creator of Turtle Trading System, Richard Daniels, once famously said, I could trade without knowing the name of the markets because I have a system tells me exactly what to do. Building a trading system is more than finding the best trade setups. A well-designed trading system is a roadmap. No matter which market environment you are in, your system will guide you to reach your destinations. So please make sure you have your own complete trading system before you place your first trade, before you start trading with your real money. Alright, we come to the end of this tutorial. Hope you guys are enjoying it, and most importantly, hope you guys learned something valuable. In the next tutorial, we will go through the module 5.2 and share with you guys a real-life example of how a complete trading system looks like. Again, thanks so much for watching, and I will see you guys in the next video. Bye for now.